Officially, good morning. Two Craig M's? Oh. Are there two of you? Two Craigs? One Craig M, one Craig without. Maybe we have two Craigs. Okay, press is here. That's what I was waiting on. So we'll go ahead and get started. Good morning to you, Press. Good to see you. Welcome, everyone. Sunday Market Insights. I am Scott. I'll be your host. We have an amazing group here. Yes, there is. Two Craigs. Love it. Love it. Always, as always, education, illustrative purposes only. No recommendations. All decisions made should be done so at your own risk because we're not brokers, we're not advisors, blah, 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 yada, yada. What are we going to do today? Let's posture this market. Let's really make sure we have a good sense. There's some good things. There's some bad things. Let's make sure we recognize what our concerns are. Let's make sure that we think about potential triggers. And you're like, what do you mean by that? Like a trade trigger? No, I mean like a shift trigger. Something that says, oh, if we get X, we're more likely to raise our score. If we get Y, we're more likely to lower our score. What those triggers would be so that we can kind of look at this and be thinking, which components are most likely to shift and give us a better idea of what's coming next. I think we're going to have some stability today, but then if we have stability, the question is what would cause us to go, up or down from there? So we don't want to just score. We want to be thinking proactively as well, if we can. I think we can. I think we're up to the challenge. The Craigs and Steves are taking over. Yeah. Couple Steves, couple Craigs. We have a couple of Bobs. Yep. Only one Melody, though. And that's all we need. Let's talk about the economic calendar. What sectors we think we may want to search in order to flesh out our watch list a little bit more, buff it out a little bit. We do have Bob Roland and Bob Walker here. We've got all the pairs here today. Love it. We'll build our opportunity list. Let me get my note card ready. Obviously, I need that. And lastly, but certainly not leastly, we are almost done with another round of our trading plan loop. It's a loop. We circle and circle and circle, constantly trying to make our plans better. So, as far as that goes, we finished record keeping, and we are now transitioning into analytics, which basically means now that we have a spreadsheet that automates a lot of our calculations, we want to make sure that we take that new data and start processing it and decide what we do with it. So, okay, let's go. Let's get into it. Let's go. What's this? Okay, I don't need you. I don't need you. I don't need you. I don't need you. I do need you. And I Do need EU. July inflation data has economists on edge. Yeah, absolutely. As it should. What do we have? Jackson Hole speech. Walmart earnings. Why Goldman Sachs says the Goldilocks stock market may get hit. Okay. I mean, that's great. It may get hit, huh? Yeah, I'm not seeing much. Not seeing much. Okay. Let's go back. Let's go. I had to restart my computer, or it got restarted, so I have some things open that I didn't think I needed. Okay. This is what I need. Let's posture. So here's the 17th. Let's go 1 week at a time, or let's go one component at a time. Let's go to the SPY. Let's go to the 5-year weekly, 3-year weekly. Stable as is. No need to change. You know what? Let me get rid of this. Don't save. Now that's where it should be first. Okay. We are a 1.25. We've been a 1.25 for a month now. So we go back to here. When we busted back in, we rose it up. For me to get to a 1.5, it has to get up to here, or it has to bounce, I would say, halfway between this red line and this red line. So like, if you were to draw... If we were to draw a line just sort of splitting the difference up here, that's pretty loose. But if we were to pull back and only pull to here and then bounce, then I'm thinking, wait, this looks more like these lines back here by angle. These were a 1.5. This green and this blue were a 1.5. I don't know what this is. I don't know why that's there. To be fair. That's a 1.5, and these are a 1.25. Although I kind of feel like maybe that's even a little stronger. That's all right. We're going to go with what we have historically. It's got to either get to the top now. Let's change this to red. If it gets up here now, or if it gives me that bounce, then I would raise it. So I don't see any way that we score this differently in the next few weeks. It's going to stay at 1.25. Even if it starts to drop, we're like, oh yeah, we would expect that. No big deal. Does anybody currently have a different score for their long term than I do? I'm at 1.25. Good, solid score, good, solid trend. Our slope is much steeper now than when we were scoring 1.5, Steven said. So you're saying this line here is steeper. Is that what you're saying? The problem is we don't have a trend in here. We just have that's like this back here, right? That wasn't a trend at the time. We need to see a consolidation in order to have a trend. So otherwise, what you're going to find yourself doing is saying, I'm going to score, I guess you would say this is your trend. And you can see that's not really indicative of a trend, right? Like that's very difficult to be like, that's my trend. Well, it's moving up. We're looking to measure a trend. And so first and foremost for me, I'm going to cut off the V part because that's a V. That's not really in a trend, right? You can see back here we had kind of a V. And imagine if we would have just drawn the V as our score. That's what it would have looked like. Of course, that's not sustainable for a long-term trend, right? So that's why I'm not doing it. If you're saying I'm going to raise my score up, because if you're saying it's steeper than when we were a 1.5, then you're saying you want to go 1.75, which is almost a perfect trend score. Then you have to stop and ask yourself, is this what we consider a perfect long-term trend? And then when you ask that question, I think we all would be like, no, I don't think so. I don't think that's how we want to go about evaluating and scoring a long-term trend. So what we're looking for is something that establishes trend, right? Like, oh, okay, it's so if you look from the V, we really only have like this data coming out of the trend or coming out of the V. And so if you were to say, well, let's discount this whole V because it was a big ass drop followed by a big ass recovery, where does it leave us? It literally puts us right back in this trend here. If you notice, we're just barely moving back into that. And even then I said, if it gets to the top of it, I would still say, you know what, I'm going to give it the benefit of the doubt and give it a 0.25 point. But realistically, all we've done is moved back into that trend, which we were scoring back then. Back in this area before the drop. Let me see if I can't highlight that. There you go. Back in there, we had dropped from a 1.5 to a 1.25. We're just after this recovery barely moving back in. So what I'm saying to you, Stephen, is we don't get to go from the bottom of a V and then draw that and then say that's our trend. The V's job was just to get it back to where it was before the big drop. Now we've got to move back into where we think an actual trend exists. Does that make sense? So that's what I'm doing, is I'm discounting that recovery because that's all it was a recovery of a very quick 20% drop. Yeah. Oh no. Yeah, I agree. It's good to discuss it. I think that's a great point to bring up. 100%, right? Like, let's talk about why are we. I want to make sure that that's clear, that I'm not going to go back that far and say, oh, let's start our trend from the bottom of the V. You're like, wait, what? No. No, not from the bottom. Let the V recover, then start to draw, which is what we did. We said, okay, we have our recovery, and then now after this recovery, we're here, and we're saying, what is this doing now? Well, it's doing pretty well, right? We're seeing if it's, but we only have, from that point, we only have one down week, and we're trying to see what's the next consolidation, which we know we're going to look like. Okay. That's a great conversation. I'm glad you brought it up. I hope everybody else is too. Let's drop down to 6 months daily. That's not it. That's it. Here, everything has been pretty stable. So if I draw it, and again, right, we're kind of saying, even if I were to give it to here, like to this point, and say, there's our recovery, then what? Then we draw this and we say, oh yeah, I've got a well-established short-term trend. And we're right in the midst of it. Is that a real strong trend line? No, strong would look like this. This thing's just kind of in the middle. It's definitely not flat. It's definitely not strong like that. What's it doing? It's just kind of going right up the middle. So what is our score? My score is a 1.5, right up the middle. Look how solid this trend has been. This has actually been pretty stable as well. We've actually had a pretty okay. That's something we are to some extent anchoring to right now. So those two scores together are staying the same. That's a good solid score. Out of a 5-point possibility, we're at a 2.75. That's good. It's not great. It's good. It's better than fair. It's good. Nice, solid, good. Let me know if you have any questions, comments, or concerns about that. Yeah, this is a little bit of a tough market right now. Trying to get a good sense for it with a lot going on, Stephen. I think you're right about that. Okay, let's talk about volume then. Does that help? Will volume give us some sense of conviction? Let's go down here. Average was 70 million. We got 68.5 million. Wouldn't have mattered even if it was above average volume, because you'll notice what happened on Friday. It gapped up. Then it sold off and only finished down 0.23%. That's not enough for us to be like, oh, look, the sellers took over. Nobody took over. It paused on average volume. So what do we have? We have 2 ties and 1 big sell day. That big sell day is definitely a big one. But from that big sell day, what happened? We've gone straight up since then. We had 1 big day of volume, bam, pushed it down, and then we recovered. Okay, so let's talk about that. So I have 1 sell day, 0 buy days, 2 ties. So you might be thinking, all right, Scott, so you're going negative. No. Remember that if my score was 1, 1, and 2, just 1 buy day, then we would consider this a tie, and tie goes to the buyers. So this would equal 0.25. So we can't just because of this, that's not going to take this from a 0.25 to a minus 2.5. That's going to take this to a 0. This, what we have now, the 1, 0, and 2, 1 sell day, 0 buy days, 2 ties. We're going to call this neutral and give it a 0 score. This is the start. This is the end. This is the line of sanity. I've got a 0 score with a slightly uptrending line. I live with that. This is not, sometimes we would use the line of sanity to make an adjustment. I'm not going to be like, you know what? I'm going to adjust this to a 0.25 because it's upsloping. Nah, that's not what we're doing here, right? Not at all. What we're doing with this is saying, okay, we're still gaining ground and we're doing it on neutral volume, which is okay. That's reasonable. That's fair. That looks good. We like that. So unchanged for me across the first 3. Unchanged here for the second week in a row. So what are we seeing here? We're seeing stability. Stability with still maintaining a good amount of bullishness. We've seen a bit of regression, but from the regression, it's stabilized. Steve C agrees. So does Tony. And that's all I need to hear. Okay. Questions on that first component. What should this be doing for us? It should be hopefully like if you were feeling like, oh man, this market's really looking ugly, it's looking bad, you should be like, no, it's not. Yeah, there's certainly some uncertainties about it. Certainly some uncertainties. I see that. There are most definitely uncertainties here that are causing some hesitation in the market, but overall the trends have held up. That's a good thing. Let's go to the major market. Major market has actually been quite favorable as well, but relying on the NASDAQ. The question we keep asking is, are we going to see some level of small cap participation to boost our score, or do we start seeing increased Dow participation, which we would interpret defensively, and we would say that's going to weaken our score? The bemused have it. Stephen, Bob Rowland are all in this. Look, it's a quorum. That's a quorum. Small cap strength means what? Small cap strength, Craig M, is us looking to see the last piece of strength from a major market component. It means that the appetite for risk has increased enough to well, and what's going to help specifically with the appetite for risk in regard to small caps, and that is interest rate reduction, right? The small caps are going to be the most beneficiaries of, or are going to benefit the most from interest rate decline. And so if there's increased expectations of that, that is bringing additional appetite for risk. We want to see convincingly that the small caps are showing that when they haven't. That's what you're going to see when we come in. So if you notice right now, it's a great question to confirm that. You can see up here we have the NASDAQ leading the way. Tech can carry. That's something we know. Tech can carry. So if only tech is leading, we will allow our score to remain at a 0.5. That's half of what we need. If we want to get to a 0.75 or to a 1, we need the small caps participating as well. This is our watermark. And you can see right now it's a battle for third between small caps and the Dow. And the Dow is winning. So there's more in the defensive than there is appetite for risk for small caps. If we can see that shift and we can see the small caps start to move consistently into a leading position, then we're like, okay, that appetite is increased and we like what we see there. That's the only way we'll get back to like a 6 or a 7 on our market posture, is if small caps are participating. Let's drop to 133. And you can see still NASDAQ leading, still S&P giving us that balanced watermark. And here is the battle for third. And you can see that the Russell has, since the pandemic, really tried to dip the worst. Not the pandemic. What am I talking about? Since what the hell, Scott? You're going back 5 years, buddy. There was a while that I was oriented around the pandemic so consistently. Since the tariff reveal party day, back here, it's caught up. You'll notice that the Dow did not dip nearly as much. It dipped down 15%. This dipped down 25%. So it was much worse. And now they're about in the same place. So we're seeing progress. We don't really score progress. We're already at a 0.5. We only score merit, not progress. This is a meritocracy. You don't get credit for trying. You get credit for doing. Let's go to 66. Oh, well, still more progress, because it went from On the 200, it was at the bottom. On the 133, it caught up to the Dow. And on the 66, it passed the Dow and caught up to the S&P. Better. This is definitely more better than it was before. But, is it leading or is it progressing? I say progressing. If we were to say leading, we would say, okay, maybe that's enough to now move our score up. Whoa, no, that's the wrong spreadsheet. From a 0.5 back to a 0.75. And you can actually see for a minute there, it did. I did back here go to a 0.75 for a couple weeks. That was back here when you saw this, like, it was trying to leave right in there. You can see, look at that. It was so close. I think I may have been a little bit preemptively accommodating with that score as it fell back down and tried and fell and tried and fell. And so let's see. It's not there yet, but it looks better than not. What do we not see happening here? We don't see institutions shifting money defensively. If we saw that, we would see the Dow pushing, not lagging. So whatever else, even though we're not changing the score here, this looks better than not. This looks like it's moving more towards a 0.75 than a 0.25. If I put a probability, I'd say there's a 70-30 probability. I'm giving it better than 2-to-1 odds that the next score it gets is a 0.75. Why is that helpful? Well, because if I'm going to trade, I don't want to trade where I'm like, oh, this is really feeling iffy. I want to trade when I'm like, okay, this feels like it's shaping up. And if anything comes down the pike next, it's another bullish increase. Oh, I didn't even know Phil had joined us. He liked my Mo Better use. Okay. It's actually, I'll tell you something. And Phil probably knows this too, but there's a restaurant out here. I'm a huge lover of Hawaiian food. Love Hawaiian food. And there's actually a restaurant out here where I am called Mo Bettas. And it's a Hawaiian joint. It's delicious. If you're ever out in the Utah area, go get you some Mo Bettas, because it is mo better than most things. Oh, Craig's had it. Phil had it last night. I love Mo. They have a new one down the road for me. The Hawaiians know how to eat. I'll tell you what. Okay, Russell. Press says the Russell Small Caps. Craig giving the address. I love it. I've been to that one. The Russell and small caps are much more Fed rate sensitive, and based on the last yes, the PPI was definitely sobering. That's 100% right. I knew what you meant. Yeah, we'll look at that. We'll look at that, Press. I agree with you 100%. That's a great summation of that. Let's go take a peek at the 22 just to see what's coming. And you can see they got a big piece up, and then they got PPI, and they're like, oh, they shrunk very quickly. Yeah, it's definitely. I tell you, I moved my probability closer to not than to at this point. So, okay. I think we're all in agreement. It stands our current score of a 0.5, which is half of what the strength it can give, and all it can give without any participation from small caps. It stands. The NASDAQ has been at the top the whole time, and it can carry. It can carry us. It can do the job. But it can't carry us to a 6 or a 7. It can carry us to a 4 or a 5, and that's where we are. So more of the same. Let me know if anyone has questions. We're having some great conversations about connecting these into like, why do we think this? What does it mean? And how do we, keep an eye on what it might do next? So, okay. Let's go to sector rotation. And let's just start with an orientation of what we see here. Let me get rid of this. Let me get rid of these ads. Who's at the bottom? Healthcare, materials, energy, staples, all defense or commodity oriented. Who's at the top? Communication services, technology, discretionary, financials, and industrials. That's what we need to get this. The more we have those growth sectors, when the economy and the market, when things are good, what do we think? We think they're going to finance things and build things and buy things, right? So that's financials, that's industrials, that's consumer discretionary. We know that technology is just sort of like leads all of that. And communication services is technology adjacent, a lot of marketing, a lot of advertising, getting the information across. Those are all what we would expect to be doing well, and we see that right now. Let's just get the score of what we're orienting around. So this one is actually dropped. So that looks great. So you have to wonder what gets weaker as we go through. Let's go see. Okay, 133. Who's at the top? Technology. Who else is there? Industrials. Who else is there? Ooh, utilities. Now, utilities, we put an asterisk next to it. Why? Because it's sort of taken on more of a not just defensive anymore, but utilities are really fueling right now the disruptive new technologies, the disruptive industries that are forming are tech oriented. It's crypto and it's AI, and that's all very energy hungry stuff. And so, right, press is saying, yeah, it feels like a growth sector right now based on what we're seeing. I'm not going to argue with that. I'm not going to be like, no, that's defensive, because I think he's right. This is an ongoing discussion we've been having. So there you go. Now, who else is there? Well, we've got industrials there. We've got communication services. You're exactly right, called it a hybrid of sorts, right? Because I do think it will take on a defensive quality again if we do see the market position itself that way. So that's where I'm like, I'm curious how this will play out. But we haven't seen that nor needed that, because if you look, we have three at this time frame. We have tech, industrials, and communication services leading, and then we have utilities as a hybrid. That's still oriented more bullish. Then who do we have? Ooh, staples. And then we have financials. So okay, it's not as strong on this second time frame as it was the first. So that shows a little bit of regression as we zoom in. We go to 66 days. What do we have? We have technology. Ooh, we have a second. Which is good. And it's good that we had a trade in there. Google, right? Google. I think everybody made money on that one. Maybe still some people in that one. From a trade alert perspective. So we have communication services in there, and then we have the S&P. Utilities is kind of there. Industrials, discretionary. So, they're close. When you look at who's near the top, you still have utilities as a hybrid, and then the next two are growth. But we now have two. That's not enough. I need three. I need three to go back. What are your thoughts on this? I was thinking about this one as a maybe. I would want to see one more, and I would even have counted utilities, but with only 2 above and with utility or communication services just barely getting there, I feel like I'm going to leave my score the same, 0.25. Did anybody raise theirs? That's one that I'm on the fence with, like a little bit. And if anything, my score would adjust higher, not lower. Steve C said no. Stephen D said not enough. Press said no change. Bob Walker said no change. Love it. I agree. The good news on this one as well is that if it's leaning one way or the other, it's leaning more toward a bullish increase, not a bearish decrease. Same with major market. Like everything that we've talked about has been like, do we consider scoring it higher or lower? Yeah, higher. Most things are pushing that are showing right. So that's good news. That's good news. Let's go finish with the VIX. Ooh, gosh, you're right. I almost like I'm gonna. I don't want press to be upset with me by not going to the 22-day. Okay, what's happening here? It's a mixed bag. It's a mixed bag. Utilities, well, it's up top and dropped. We've got communication services moving into a more aggressive position. We've got discretionary moving into a more aggressive position. If we're going to boost our watch list, and I'll tell you this, just a quick thing for everybody who's here. Next week is when our schedule changes begin, but not to the second half of the week. So we have one last Monday night session together. One last, it started off that way back when used to be what we called the happy hour. And we're just like, bring a drink, have a cocktail, and let's talk. It was a lot of fun back in the day. And then it turned into just like a normal session. But remember, that Monday night is shifting to a market session. We're going to push that to Tuesday mornings. And this next week, and I'll make sure I adjust the calendar today so that you see that. On Wednesday, we're pushing the Wednesday afternoon session that Glenn runs to Thursday morning. That's a done deal. He's doing it this week. So there is no Wednesday. It still says it on the calendar, but I'm going to go in and make the adjustment. And I'll send I'll send out an announcement that kind of pushes that. But we will still, I was going to do it, but like I said, on Tuesday, I have to leave early and drive up my daughter to Utah State. So I was like, well, let's just wait one more. So the week after, we'll start that one. So Monday night, yes. Wednesday afternoon, no. And then we will, going forward, have everyday morning coverage. I think it's an amazing idea. Really allows us to connect to the market more consistently. But I am interested in your feedback. So as we make this switch, definitely keep us posted on your thoughts. You guys help shape the group. Oh yes, good. I'm glad I remembered that. So yeah, let's talk about the 22-day consumer discretionary. Right, that's what I was actually going to say. The reason I brought it up was exactly what your observation was mine as well, Press, is that on Monday we are going to search. It's our last chance to do Monday searching, Monday watch list development. We'll still do searches in other times, Tuesdays and Thursdays. We still have our Tuesday, Thursday back-to-back, sessions with Glenn and I. So that's a great time for searching, which is what I'm going to do, switch it to that. But I'm going to search where? Communication services, consumer discretionary. Those are the two. I feel like we haven't done either of those for a while. So let's go find some things to put on our watch list. Okay. Good. Done. this looks okay. I mean, if anything, utilities is still there, but we see discretionary, we see communication services, and we actually see a little pause on technology, which is fine. It's such a strong leader across every other time frame. This also still looks good. Still looks like, if anything, it's pushing me more towards the upside. Okay, so unchanged there. So are we going to have an unchanged? My thought was that we would go up a quarter to maybe even a half. We better hope that the VIX brings us something. We better hope. I'm saying that because I know it did. Well, but what it did do is it did give us a lower low, which is scoreable. Interestingly, now if it was a higher low back here, it would have been a hedge. But now that it's a lower low, that is an increase. I am raising my score to a 1.25 not 11.25. That's way too high. 1.25 out of 2. It's getting better. However, what we said was, if you have 3, 4, 5 positions that you're carrying over the weekend, would you consider a hedge? Hell yes. If you're going to hedge, you want to hedge at 14, 15, not wait. Because if this thing takes off from here, that hedge is going to do great as you're doing what? Cleaning up the rest of your portfolio. So if you have a bunch of bullish trades on, you're going to have to work those, manage those. And if you're doing that, isn't it great to have something that's working on the other side? That's where the hedge kicks in. This was not a hedge trigger, but certainly a hedge consideration. We'll see. What's ideal for us here? Ideal for us is if this were to go up, it goes up a couple of days and pauses underneath this moving average. And then it rolls over. And then what? Well, then that's a lower high. That's another 0.25 next week. That would take us to a 1.5. And this would be a great time to be thinking about entry. Explain my hedge. So the hedge is only if you're carrying enough trades to need to hedge, which, like I said, 3 or 4 minimum. If you only had 1 or 2 trades on, there's no need to hedge because you're probably going to end up wiping those out very quickly if things start to go wrong come Monday. But if you had more than that and you're like, ooh, if this thing were to gap down, what would that have done to me? Then what I would do, and it's the same hedge that I always think about, which is 5% out of the money, 5 weeks out in time. So what does that mean? So my scores stay increased. Let's take this back to SPY. Great question, Bob Rowland. I'm going to take 646 and I'm going to multiply it by 0.95, 613.7. Okay, now that's not like I need the 614 strike. That means I'm going to go somewhere in that range. I still like to do round numbers. 600, 605, 610, 615. You get better. It's just tighter. There's more action there. So I would probably either go to the 610 or the 615. That's what. For when I would go out to 35 days. Well, there it is. I would probably go 33 because it was 35 a couple of days ago, and that would have been the standard Septembers. So this is what, and the what would be either a 610 or a 615. Not bad prices. I mean, it's not all the way back down to like we've seen them for $1.80. 5 weeks out, 5% out of the money. We've seen that for $1.80-ish. Right? That's when the VIX is down at 10 or 11, 12%. When we were back, I've got to hurry and get to the watch list, you guys. I've been yapping. When we were back here, when we were seeing this, you'll get those hedges for even cheaper. Even cheaper. So yeah, I'm gonna raise it because it's getting closer to this. Down here's where we really want to be and live. If we can live down here, we'd be very happy as traders. I promise you that. So end result is my messy desktop is a 4.75. Okay, so we dropped, but we stabilized here. We didn't drop further. That's good for now. We can live with that for now. Of course, tomorrow we'll transition our market posture into our trading posture because what's going on? Let's even start that. So that's market posture. You'll notice that when we do market posture, we don't talk about support or resistance. We don't care if it's at support or at resistance. We care the trend line. When it comes to trading posture, what are you going to actually do? We very much care. So it's not like we ignore it. We just don't incorporate it until it's time. When it's time to talk about what exact trades are we thinking about, now we do need to be thinking support or resistance, because if we're at or near support with an uptrend, then trades are setting up. If we're at or near resistance in that uptrend, then we're cleaning up trades and looking for setups. There may be some off-cycle trades available, and we'll see in our watch list. But this is how we're transitioning this into what are we actually going to do come Monday morning. Okay, let's go to the watch list. One thing we did not do, actually, real quickly, let me do this. Let's take a quick peek at our Fed watch. And at this point, I actually put myself here. Always with a smile. That's me. I'm leaning a little bit more towards the 15 and a little bit less to the 85. And this was 99 just like 3 days ago. So it's definitely come down when we got that inflation report. I don't know. That was not good. So that's how I envision myself. Not alone, Gene says. There you go. There you go. Let's take a quick peek at the others this year. Massive pressure. Yeah. Ooh, press even. And then here you can see some people think we're going to, more than not, think we're going to get 2 by October. And I think maybe we get the first by October if that inflation data calms down. And then you have some people think 3. I don't know. That's what this illustrates is that what gets priced in is very much hopeful. Very much. And we've seen that a lot. Okay. Watch list. Let's find what's tradable. Great discussions today, by the way. I hope everyone's feeling pretty comfortable with what we're seeing here. Let me get back to 6 months. AAP did not do well, right? We got this little piece and then just sort of, tried to pick a little bit out of it prior to earnings. We got out before earnings, of course, and did so. So the hedge trades or puts? Absolutely yes. Absolutely yes for me. Now, some people might buy calls on a VIX product, calls on the VXX, calls on UVXY. That's going to have the same implication. So because the VIX is inversely correlated, it's going up when the market's going down. So you're either bullish on the VIX or bearish on the SPY, and either one of those could take on a hedge meaning. That's a great call out too. Press, just if you didn't see his comment, he said PPI, typically the producers comes before the consumers. So that's a precursor to some extent. Apple's on my list. Apple looks great. We love Apple being strong due to its pervasiveness in the market. It's 11% of the NASDAQ, 7% of the S&P. Very, very good to see that breakout. But we now need to just wait for a consolidation to produce a trade. ADM, same thing. Got to wait. But it's on the list. It looks strong. I just need a pullback. I could get a flag in a matter of days. They could still be viable this week. Amazon gave a little sneaky reversal here. Got to just watch and see on that one. I do like it, though. I'm not going to put it on yet. APH looks great in consolidation and could be a trade anytime in the next 1 to 4 days. No problem. AXP. Actually, I'm gonna say this was the line of consolidation right through here, and it did this. If this were to do like an Amazon style sneaker reversal, I'm gonna say yes. I'm putting that on. Credit's coming back. Credit's coming back. BAC financials. I'm iffy on. They're maybes. I really don't feel like Bank of America even got back to its old high, so that's concerning. BTI. This is a little bit more consumer staples. It's tobacco, of course. It's a staple, I guess. It's a strong trend, and if this thing turns, I think there's definitely potential there. So Beyond, it's trying to break out of its hiccup. That's a maybe. Citigroup, I don't know. There's still some iffiness for me. Caterpillar, I actually still think Caterpillar is viable. It has not broken this support level. If you took Caterpillar, I'd be like, I get it. That's valid. And today you'd be thinking it's hiccuping and you don't want it to break this support. So we'll keep an eye on that. CCJ sideways, CELH too high, CLS setting up. Come on down. Come on down. COF. I'm going to put it on just like AXP, but I would only do one of those. Visa, likely a similar construct. Coinbase, not yet. Not yet. Maybe if it, well, if this is my line, then maybe I think it did get through, and it's another one of those sneaky reversals. It's not real strong, but it could come through. I'm going to put it on there. I'm going to put it on. Put it on the list. Cisco, no. Too much sell-off on earnings. Delta. Yes, but overextended. Next pullback definitely looks good. DoorDash, viable. Viable. Still got some great stuff on our watch list, right? I mean, very strong. Here's the Dow. Looks okay. Dollar Tree, viable. Looking good for a setup. You can see this is bringing us a little bit of consumer defensive balance with BTI, with DLTR, these consumer staples, if you will. EA. Man, we were looking for something on this. We just were too early. I'll still put EA on my list. EL, Estee Lauder, too close to earnings. I would be thinking about it if it weren't for the earnings just sitting right out here. There's not much you can do with that. Expedia, a little overextended. Ford, I don't know about Ford. Futu, too close to earnings, but tell you what, it made the move that we were looking for. GE on the list, which means I would expect GE Vernova also on the list, and it is. Gold, no. Google, yes. Anybody still have a piece of theirs? Let me know. Just couldn't quite get that last little bit, which is always sad. That last little bit's always worth so much to us when we get it. But I'm keeping it on the list. If you took it, I would expect you did okay with it at least. Goldman Sachs. I'm putting it on the list because that's the best one I see in financials. Hasbro, a little too overextended. Hood is a potential. In fact, that would for some people could have been a viable break of a flag. We're going to see. We're going to keep our eye on it. We'll see what we think. HWM, no. It was on my list last week, not this week. IBM, no. IWM. I got to tell you, the small caps had a break. People are thinking about it. I think it's maybe not going to come to fruition, but if momentum keeps coming, I'd be interested. JOBY. Oof, no. KKR, no. Levi, maybe. LITE, Lumentum. Yes, looks good. Strong trend, pulling back. Come on down. There's another. We got plenty that look viable for the early this week. Meta. If it pulls back, I'd trade Meta. I hate when I write on my card too big, thinking I'll have plenty of room, and then I run out of room. Morgan, yes, to Morgan. Add it with Goldman. Microsoft. Microsoft gave a signal here, hiccuping here, still hasn't broken support. We'll keep our eye on this thing and see. Micron looks fantastic. Ooh, we were going to look at Intel last week and maybe add it due to the potential for chip tariffs, which are going to create great opportunities for American chip companies like Intel and Micron. So Micron's setting up more. I'm going to add this to the list, though. But I'll put Micron on for sure. Netflix, not yet, but soon. There may be more, because even if the government takes a stake, I would imagine they're going to have to do it like gradually, right? Otherwise, I mean, they I guess I don't understand. Maybe I've never really thought about, like, when the government buys, where do they do it? Do they take a stake with shares on the open market, and they have to go and, like, within a brokerage account and buy shares, or is this like a black pool kind of a thing, dark pool? We should look into that. I'm not even sure when they buy. Do they actually add buying pressure to the market and then selling pressure when they get out? Or is this done outside the market? That would be so antithetical to how markets work. Now I'm super curious. MP, same thing? Oh, yeah. Berkshire bought a bunch of UNH. I would wait for a pullback, but then yes. Yeah, always good when government money's coming in, right? Free money all around. Nvidia still looks good. Let's put that on the list. They're not getting hurt by the chip conversation. PGY, meh. PLTR, of course, our most favoritist of all. Roblox, oof, don't like the gap down. Reddit, still too high up. Rocket Labs, maybe there. I know Stephen D wants a little more piece out of this. I'm a little uncertain with this thing grinding it out sideways here. RTX, I would still put on my list. SoFi, I would put SoFi on my list. Here's the SPY. TME did great on earnings. I'm looking for that coming out. Watch list is still quite strong. Tesla is actually viable. I'm going to put it on the list, but I'm not a Tesla guy. TSM, not as much. Uber still looks okay. Visa, I think the other credit stocks look better. VRT still looks okay. And Walmart, coming out of earnings, maybe has a possibility, but be careful for earnings. There's a new Walmart just like right around the corner from me. I'm very excited. I walked up to it and walked around. I'm like, whoa, it's huge and looks nice. I'm very excited about it. That's the list. Last but not least, our trading plans. Let me get my trading plan document up here. Last but not least, we are why is that in the way? We are now on analytics. And it's funny because you're thinking, oh, record keeping's easy. It's 2. And analytics is much harder because it's much longer. But it's actually the opposite. If you put your trade log into place, this is what you get. You get all this so that you get to review it and you get to start coming up with, what does that mean? What are my patterns? If you haven't done it yet, it's amazing what the insights that you get from this are when you start to see patterns in average win size, average loss size, patterns, and connecting your percent winners to market conditions and things that you would never have done before. So remember what I said last week. Show me a good record keeper and I'll show you a good trader. So it is paramount to what we're doing. And I'll finish with this. Successful traders do what failing traders don't want to. Nobody wants to get into data entry and stuff like that, but it opens up a whole new world of insight and perspective. So there it is. That's my soapbox moment to get your record keeping and your analytics in place and a part of the regular routine. Good quotes. Thank you, Press. I appreciate that. That's it. Thank you for the extra 8 minutes, everybody. I appreciate it. Thank you for spending your Sunday morning with me. I love it. It's amazing. I'm on my last sip of coffee, so that means time is up. Have an amazing rest of your Sunday. Let's look to have an amazing week. As always, happy trading.
Recording stop.